Good evening and welcome to tonight's presentation. My name's Charlie Burton, and this presentation is on the coming volatility storm in 2025. I've been trading 27 years. I'm an authorized money manager here in the UK under our regulatory bodies. So I've been doing that since I think 2018, managing other people's money for the last 6-7 years now. And I also am a trader coach as well. I have been featured on things like the BBC and trading documentaries and interviewed in the usual publications over the years, like such as the Financial Times and the Telegraph, and been on BBC Radio and all sorts of other things. Okay, that's enough on my background. So this is the presentation this evening, the coming volatility storm. It's funny, actually. I was speaking to one of my brokers earlier, and he was saying on the phone how excited he is, so to speak, for next year, because again, brokers can see the potential for next year, what with Donald Trump becoming the new US president and the potential for volatility there. So that's what this presentation is on, is where are the themes going into 2025, and what on the back of Donald Trump, I'm sure most of you know the potential policies that he's going to be imposing, the implications for the markets on the back of that. Right. First up, the risk disclaimer. Material provided is for information purposes only and should not be considered as investment advice. The views, information, or opinions expressed in the text belong solely to the author, myself, and not to Tickmill. CFDs are highly complex instruments and come with a high risk of losing money rapidly due to leverage if you don't use stop losses, for example. Okay. So let's get into the overview here. So we're going to be looking at the sentiment picture going into 2025. It's quite a fascinating backdrop that we've got right now in terms of sentiment. We're going to be talking about Trump trades. We're going to be looking at some big picture chart patterns and how to read hedge fund positioning. But first, let's have a look at this just very, very quickly. Like I've said, you can get hold of the prior presentations if you go to tickmill.link/Charlie Burton. That's tickmill.link/Charlie Burton. If you struggle to get in there, just send Giuseppe an email. So that's Giuseppe@tickmill.com. In fact, if you have any questions, do contact Giuseppe. Tickmill, if you don't currently use them as a broker, they are one of the top brokers globally. And my experience of them is that they have very good low charges, and their overnight charges, because I hold positions overnight as well, their overnight fees are very low. So if you don't currently trade with them, I would seriously recommend you checking them out. I am independent of Tickmill, but only reason I work with Tickmill is because I respect them. I like them as an organization. It's well worthwhile checking out. In fact, if you come to this link here, tickmill.link/Charlie Burton, I'm going to have to just press escape out. Oops, there we go, out of there for a second. This is what you'll see. It comes to a little hub of mine that Tickmill have put together. And if you scroll down to the bottom, there's a load of the previous presentations that I have done here. And if I scroll across, there's an arrow here. And there we go. We've got a load of presentations, webinars in here. The road less traveled. What else have we got? Market sentiment. There's 2 road less traveled ones there. Low frequency S&P trading strategy. Anyway, there's a load of presentations there. And if you wanted to, I think it's on here. You can get access to my trading room. I have a live online trading room. You can get free access to that if you open an account with Tickmill as well through this site. There you go. So it's a little shameless plug there as far as Tickmill are concerned. Right. Let's get the presentation back up. Oops. Okay. And do make a note of Giuseppe's email. So if you need anything from Tickmill, or you have any questions, do fire him an email. Right, let's get started. Okay, so from a sentiment perspective, as we're coming into the year end, what I'm noticing time and time again is pockets of euphoria at this stage in the year. So we're seeing quite a lot of euphoria at the moment, and high expectations of further stock market gains. So stocks could gain another 20% in 2025. Embrace the bubble. This was in Barron's magazine just the other day. Then the conference board in the US, they survey investors about their expectations of stock prices over the next 12 months. And as you can see here, we've moved to new all-time highs going right away back to 1988 when the data started, that actually investors' expectations are at new highs, new all-time highs. So again, a little bit euphoric there at the moment. If anyone doesn't understand euphoria in the markets, then when investors become euphoric, what you have to consider is who's left to buy, so to speak. So the more and more people that have high expectations for the stock markets, well, the analogy is that they're already therefore invested, because if they've got that view, then it's likely that they've got their money in the markets. And when everybody is expecting the same thing, who's left to buy? In which case, it doesn't take much selling to then bring the stock markets down, at least a bit. That's the general thesis, so to speak, behind and thoughts behind market euphoria, and it's the same the other way around as well. So let's have a look at some more. The Economist magazine, just recently, about a month ago, this came out. The Envy of the World, America's economy, a special report. So love that one, front page there in the Economist. Then we've got total US speculative option volume. So in 2021, although option volume was higher in 2021, that was massively euphoric at that point. We were still having lots of lockdowns. People were sat at home and got into trading. So, that was very high volumes, but there were other reasons behind that in 2020-21, because so many people were sat at home. Now we're into 2020, late 24, coming into 2025, and look how high by historic standards we are again now. So speculative activity is on the rise in line with those expectations. Talking of expectations, again, that conference board, this is the conference board, so that I've just shown. So the expectations are at new highs as far as stock prices, and yet expectations over the next 6 months for income is nowhere near there. So we've got investors with very high expectations from the stock market, but they're not expecting incomes to go up. So something's got to give there. And then if we come to Wall Street Bets, so this is, again, another sort of social media sort of platform, isn't it? Wall Street Bets, Fear and Greed Index. Here we are coming into 2025 with very high levels of greed by historic standards. So whatever way we slice it at the moment, we're seeing either magazine publications, financial magazine publications, seeing very euphoric, and lots of measures of sentiment are looking very euphoric. In fact, if we just look at this last one here, single stock leveraged ETFs. So that's it's a leveraged ETF on any single stock, and people can trade options on these single stock leveraged ETFs. So the amount of volume going into these is taking off massively, or has already taken off massively. And of course they can. This data is, as you can see, is as of just a month ago, and it's just a little bit worrying as far as sentiment is concerned. So right now, coming into the end of the year, we've got a lot of euphoric type sentiment. We'll have a look at the technicals of the charts for the S&P shortly and the stock markets over there in the US. But we're 2 years into the bull market at the moment. So 2 years since the October 2022 lows. Going into year 3 of a bull market, year 3 actually historically tends to underperform. So it's just the stats. Going back to 1950, year 3 of a bull market tends to underperform. So we've got a situation where there's lots of expectation on Trump. The Trump trade is what, Trump's going to cut taxes, good for people's disposable income, good for businesses, and therefore stocks will continue to rise. And that may well happen. All I'm adding here is a cautionary note that there's a lot, from a sentiment perspective, there's a lot of euphoria. In fact, I will come off of this just for a minute and come to the charts because it wasn't that long ago. Excuse me. It wasn't that long ago. Literally, this is the daily chart of gold. During this phase here, that there was a lot of positive. Excuse me, I've got a cough here. There was a lot of positive sentiment, euphoria towards gold at that point. Lots of articles being written about how great gold was and what as an asset class. And it is, don't get me wrong, but you get to these points where if everyone's in, so to speak, who's left to buy? It doesn't take much selling to bring price back down again. It's that same thing that was going on there with gold. And yet, if I come to the S&P itself, so this is the cash market, see that I've got some long-term trend lines in play here. And the S&P is just nudging against this trend line at the moment. And so, again, it's just we're nudging just some trend line resistance. We can blast through that. Of course we can. But again, it's just a little bit of a warning, if you will, that we've got this sentiment being what it is. In fact, if we look at some of the breadth measures, so if we look at the stocks, the percentage of stocks that are trading above their 50-day moving averages, we can see that's plunging at the moment. And likewise, with the percentage of stocks trading above their 200-day moving averages. So, and yet, if we go back to the S&P is right up at its highs. So what that tells us is breadth isn't great. So we've got very, very positive, euphoric sentiment out there. And we've got an S&P, if we come back to the cash market here, we've got an S&P where which is holding up really strong and doing really well. And it may well just be about to make new highs coming into the end of the year. Of course, I'm talking about going into 2025. But the backdrop is such that we're seeing weakening breadth. So a fewer percentage of stocks are trading above their respective 50-day moving averages and 200-day moving averages, which tells us that it's just a few of the bigger outperforming stocks that are driving these indices and still allowing them to hold up here. Because under the bonnet, there's some question marks there. So for me, coming into 2025, and I'm not talking about what happens tomorrow or over the next several days necessarily. The S&P could still make new highs going into the year end. But I just think just be cautious going into the beginning of 2025. Third year of a bull market, a lot of euphoria, technical trend lines here on the likes of the S&P and the NASDAQ as well. And we've got a bit of a breakdown in breadth as well. So just something to look out for. Third year of the bull market, remember, as I've already said, historically tends to underperform. It doesn't mean to say a bear market. It's just it just underperforms what happens in the first 2 years, usually of a bull market. So it tends more often than not to underperform. Right. Let's get the presentation back up, and we'll come back to these charts in just a moment. Talking of charts, let's go over to them then. So coming into 2025, where are the big themes? I've just highlighted the stock market. I think the stock market itself has that propensity for a fair bit of volatility under a Trump presidency. Anyone who was trading last time Trump was president, he'd only have to put a tweet out and the stock markets would jump around. So I think the expectation for a fair bit of volatility is coming, which is great from a trader's perspective. Those policies, of course, it depends on what he does do and how long it takes, like for tariffs, how long it takes for some of those tariffs to be implemented. But if he does implement some of the tariffs that he's talked about doing, then of course that could affect global trade, which could be inflationary as a result, which means that the Federal Reserve, don't cut interest rates as much, and that could be a strengthener for the dollar. So I've got a monthly chart up here of the dollar at the moment. Now, just 2 months ago, the end of September, the dollar was coming down and looking like it might want to go for a break down to here. But the market turned dramatically, and the dollar has now made a new high within this last 2 years now, just into November there, November 22nd, I think it was, it made its high around that time anyway. So right now, when we look at the big picture, if this trend is about to continue to the upside, technically there's plenty of upside space. Along with a backdrop of a new president whose policies could be, certainly could be supportive of the dollar, of dollar strength. Because if his policies mean that the Fed cannot cut rates, then relative outperformance is going to be there. Plus, some of his policies may again affect other economies, such as Europe. And so, if he imposes more tariffs on Europe, then that affects Europe, which would affect the euro as well. So I'll be talking about that. But certainly, when we look at just purely from a technical perspective on the monthly chart, there's plenty of space here for if the dollar is going to start breaking up coming into at some point in the new year, in the first month or two, then there's a lot of space for the dollar. There's very little technical resistance to get in the way of the dollar until it gets up into this zone up here, 112 to 114 on the monthly chart there. Now, if it did come up to 112, okay, well, it's just where there's been a lot of trading activity there, and it goes back here as well. But technically, it may want to come up to these highs. And of course, I've got this nice rising channel on, but it may want to end up coming up to this channel line, which would then see it, by the time it would go up to there, if it did have that sort of run, a strong run, and it does happen, as you can see in 2022, massive run that we had. So who knows? But if it did want to come back up to that trend line, that would come in rather nicely with our prior price action over here. Hopefully you can see my pen. I should have checked before earlier in the presentation when I first started using the pen. Hopefully you can see my pen when I'm scribbling over this. You can. Great. Thank you. I assumed you could, but okay. So that's just on the monthly. If I come out now to the next slide, which takes us to the 3 monthly chart, we can see a little bit further back, and we can still see the channel here and that high around 112 to 114. And again, puts into perspective, if we came up to that channel line. That marries up quite nicely with this resistance over here. So it's something to keep an eye out on, especially we won't know for certain what Trump's policies are going to be. We've had a lot of, he's talked a lot, but we'll see what actually happens and how long some of these tariffs take to actually implement as well. But from a technical perspective, the dollar is in a good position to carry on resuming this trend to the upside. So what does that translate to when it comes to something like the euro against the dollar? So if the dollar is going up, obviously the euro is going down. So these slides, I put this presentation together, I don't know, a week ago. So the euro, the potential on the downside, if the dollar's potential is to go back up, I just take this back up and revisit these previous highs from 2022, then the potential for the euro to revisit these lows from 2022 is there as well. And again, if you look at the amount of uncertainty across Europe right now, so you've got France at the moment. They've got elections coming, but they're not coming till July. So they've got a fractured government at the moment. They don't have a single ruling party. They can't even get a coalition together. So it's in a bit of a mess politically there at the moment. And France is a key global economy, much like Germany. Big manufacturing base, and yet, what am I doing for time? And yet, lots increased competition from China as far as electric vehicles are concerned, and just in the doldrums as far as their exports are concerned. High energy prices affecting Germany, and again, politically, we've now got an election coming in because we just had a vote of no confidence in the Chancellor. So they've now got an election coming on the 23rd of February. So there's a lot of uncertainty in Europe, let alone the effects of the Ukraine war and other economies as well. So politically fractured within the Eurozone at the moment. So again, the scope for the euro to start to break down, if we see the dollar starting to break up, then correspondingly we'll see the euro breaking down. Of course, the euro has already come down a bit. This is on a monthly chart, but certainly the scope is there. So when we're looking at these bigger themes, although you may not be trading off a monthly chart, it's good to have these themes at the back of your mind, because you may be trading and looking for opportunities, over as a market chops its way down, potentially, if it was to come down into this zone, then traders are going to be looking for opportunities to trade within that trend. And so I'm just pointing out the potentials. Of course, nothing is guaranteed in the markets, but certainly we can see the potentials there, both technically, as I'm showing these charts here, but also from a fundamental macro and geopolitical perspective as well. So it's really making for a fascinating time ahead under a Trump presidency. Okay, another chart here which looks, this is the same chart. This is the euro again, zoomed out to the quarterly time frame now. Again, it's the same. Now every bar is 3 months long, but it's the same story here of looking. If we were just looking at this from a purely technical perspective, making lower highs through here, lower lows down here, the scope is starting to build now that the euro could want to come down and retest that low. Because what do markets like to do? When they're in uptrends, they will keep retesting new highs and making new highs until they fail to make new highs. And likewise on the downside as well. So at the moment, the scope for the euro to roll over there, much like the dollar itself, the dollar index itself, is there to go higher. So it's certainly something to keep at the back of your mind there. Okay, now we've got another one. The Australian dollar against the US dollar. Australian dollar, again, the backdrop there, highly influenced by China. China's struggling at the moment. The Chinese authorities are looking at monetary impetus and even some fiscal policy measures as well to try and, I say, revive the Chinese economy. But there's a lot of speculation that that's not going to be enough. And the Australian dollar is suffering at the moment. And so, because it does a lot of trade with China. And then combine that with this technical pattern that we've got here for the Aussie. And that is, there's a lot of technical patterns going on here, but we've got a lower trend line here. We've got a break going on of that trend line as we speak. This is on a monthly chart again. So we're in a technical break at the moment, but it's also, we've got this trend line above price as well. So in fact, this creates a bit of a symmetrical triangle pattern. With symmetrical triangles, you normally measure the back end of the triangle, and you take that measurement and you would apply it to where you get the break. So we had a minor false break to the upside, which is very common with symmetrical triangles, and now we're breaking to the downside. And then you would then put that same measurement on as that was there at the back. I must admit, though, on a monthly time frame, that gives a ridiculous projection, way probably too far down. But nevertheless, even if we ignored that projection and said, okay, well, what's the scope with the Aussie? It's currently sitting, well, as I took this screenshot the other day, around 63 or so. Still around that sort of area, 62, 63. And but the scope to retest those 2020 lows, I wouldn't want to write off. So again, we may not be trading a monthly chart, but once we get into a theme, we can trade that theme. And so as we identify trading, whatever your trading setups are, you can identify trading setups on the short side, knowing full well that, there's plenty of scope for price to at least come down to these levels, and then potentially even a lot further as well. Well, you're going to be trying to hold on to a trade all that way. You're going to be trading within the trades, within all of that, how most people trade. But nevertheless, it's good to have a big picture view. It helps with your day-to-day trading to have a big picture view. So again, from a macro perspective, we've got uncertainty around China. We've got Trump, again, comes back to, those tariffs that are coming on China. If those tariffs that are introduced on China, the impact on China spills over to other nations such as Australia, New Zealand dollar as well. So it has all these knock-on effects. And just bear with me a second. I've just got to do something off screen. Let's just do that. Okay. So plenty of technical charts here, but also we've got a lot of macro geopolitical events going on as well. Lastly, I think the last one I've got here is the Canadian dollar. So again, this market doesn't look like it has anywhere to go but up. That's the trend, shall we say, at least anyway. So for the Canadian dollar, we've got these two highs up here around 146 or so as the next levels for dollar CAD. This is the dollar CAD to come up and test again. Markets once they start coming back up again, they like to come back up and retest levels. So still a fair bit of scope there. And if the Canadian dollar can get through those levels, then who's to say we couldn't get up into the 150 zone, just that bit higher, which marries up with some of this price action over here as well. So if we get through 146, 150, big round number. Markets love round numbers. So wouldn't surprise me at some point in 2025, if we do continue to push, then the dollar CAD doesn't end up going up as far as 150. So these are all big picture themes. There are no guarantees, as I say, that they're going to happen. But what we do as traders is we trade probabilities, we trade odds, and the odds favor, until proven otherwise, these big picture themes being to the upside. Okay, so that's the last of the currencies. This is the S&P chart, in fact, that I was just showing you. So we've got this trend line here on the S&P. It's a nice rising trend line going back. There's another one, obviously, across the tops as well, but it's into this one at the moment. I'm not. I don't like shorting a rising market, and so this is firmly in a strong trend. But certainly, I think, as I've said earlier tonight, with all of that euphoria that's out there going into 2025, a lot of high expectations that a Trump presidency is going to be good for stocks. Well, maybe those expectations need to be dampened slightly. Maybe we just have a bit of a consolidation for a couple of months just to work off that euphoria. But certainly, I think I'm cautious at the moment. The breadth readings, like I've already gone through as well, mean that I'm cautious towards stocks. Would I stand in front of this and just short the stock markets right now? No, I wouldn't. But I can be cautious towards what they do, because it wouldn't surprise me if they still go higher into the end of the year. But I would keep an eye out and just be wary of all those expectations out there. The markets tend to have an amazing ability to do what the masses. If the masses expect one thing, the markets tend to do the other. So maybe the markets just chop sideways for several months at least. Anyway, but I suspect we're going to see whatever happens, a reasonable amount of volatility. Okay, so let's now come back over to the charts for a little bit, and we're going to have a look at hedge fund positioning. And in order to see what hedge funds are doing, there's one place that we can visit, and that's the COT reports, the Commitment of Traders reports, where hedge funds and large speculators who are trading in size in the futures markets, they have to log those trades. So those trades are logged, and then they are made widely available several days after. So they're usually about a week, roughly a week. We'll call it a week delayed. But it doesn't matter. We just want to see what's the general theme of what en masse the big players are doing. So let's come out of that for a moment. And so what we're looking at is this. So forget all the adverts. This is a free website. It's tradingstir.com/COT. So just make a note of that. It's a free site whereby you can come down and look at the Commitment of Traders positioning in currencies, stock indices, etc., anything that's traded in the futures markets. And I would bring to your attention the legacy report. I wouldn't bother with the COT. I haven't got the time to go through the other one, which does a bit more of a breakdown. I tend to largely use the legacy report. Okay. So firstly, we're going to go to the E-mini S&P. So here, it's the E-mini S&P down here. This is the one you want, not this one, S&P stock index. That's not where they're all trading. They're all trading the E-mini here. So all you have to do is click on the COT legacy, and here's one I have prepared from earlier. So what happens is at the top, when you click on that, it shows you what the hedge fund managers and the large speculators have been doing. So it'll show you the last week what happened. Well, they added 31,000 contracts, but they also added nearly 6,000 contracts as well. They are the non-commercial. That is who the big speculators are and the hedge fund managers are. Commercial, you don't need to worry about that. That's the other side, so to speak. That's the institutions who provide the trades. Much like we trade through brokers, that's their brokers. So we're only interested in what their positioning is, non-commercial. So we can see that, but then what we do is we just scroll down until I get to the chart. And what will happen normally is there'll be 3 different lines on the chart. We don't need non-reportables because that's non-reportables, very small positions, and we don't need the commercials. We're just interested in the non-commercials. So non-institutions, but they are large players and hedge funds. So right now, if we're looking at, and it gives us roughly about 10 years worth of data, as far as positioning is concerned, zero just means that taking into consideration all of those who are long versus all of those who are short, and it gives us a net overall positioning. So right now, they're actually marginally short here. And yet, what's the stock market doing? Oh yeah, stock market's massively up. So I don't know what's going on there, but they're only marginally short. If I come back to the report, but they are marginally short. And so they're not moving in line with the stock market. A lot of the time they are. So when stocks are moving higher, their positioning will be moving higher. That's not the case at the moment. So now that could be a warning that they're not following where stocks are going at the moment. So that could be the case. So again, is that a slight warning there? It certainly raises a question mark that their positioning is not moving in line, because they tend to move more often than not in line with the market. Let's actually go over to another one. So let's come over to the euro here. So again, I've got exactly the same. I've got this one already pre-prepared. So the positioning on the euro now, oh yeah, well, this is moving in line with what the euro's doing. So if we go back to the charts, but bring up the euro dollar here, overall the euro dollar's been coming down the last couple of months or so. And if I zoom in a bit, yes, we can see that since basically September, yes, their positioning has been moving down largely in line with what the price of the euro is doing. That's exactly what we want to be seeing. So that gets a tick in the box. So, but I still have to come out, and then because there are other times I talked about on the slide there, extremes in positioning. So is this an extreme? Well, it's certainly the lowest net positioning that we've seen now since 2020? Because we've just broken, as far as their positioning is concerned, to new lows below the lows in their positioning that they had in 2022. However, historically, 2019 and 20 and back down here. So over the last 10 years, are we at extremes? No, we're not. So we can recognize that, yes, positioning is growing to the downside, but there's plenty of scope down here for them to expand their positioning. Let's move over to another one. Let's go to the Australian dollar, because the Australian dollar is fascinating right now. In fact, what I'm going to do, see if I can. So just earlier this year, there we go, perfect. Just earlier this year, the positioning in the Australian dollar contract was at new 10-year lows. So in sort of March, April of this year, their net short positioning was at its biggest of the last 10 years. So now when you get that going on, you think, oh, we're getting possibly a bit stretched. What's going on technically with the charts at that time? At that time on the charts, the Australian dollar was sitting at support. Oh, well, this could be good for a potential bounce, because if too many of them have got short, and it's their biggest short position they've held over the last 10 years, there could be some scope for some short covering rally. And especially as technically the Aussie at that time was in support. What happened, funnily enough, the Aussie bottomed around that time, and their positioning then had to massively be readjusted. What's fascinating right now is it's almost the opposite. We're not at extreme highs, but not with regards to the past 10 years. But if I now bring up the chart of the Australian dollar, again, the Aussie's been falling away here, and yet their positioning has been going up. So one or two things has got to happen here. We've got the euro where it's all moving in alignment. The Aussie is all skewed. So the potential for them to have to quickly play catch up and start aggressively shorting in line with what the Australian dollar is doing is certainly there. So again, one to watch out for. Keep watching and looking at the positioning. If I now come over to the New Zealand dollar, this is what we should be seeing the positioning like on the Aussie, because the New Zealand dollar positioning, yes, has been declining as the New Zealand dollar has been declining over the last 2.5, 3 months. So that's exactly what we should be seeing on the Aussie, but we're not at the moment. So the scope for them to have to play catch up and aggressively sell the Aussie is there. Now, as far as the New Zealand dollar's positioning is concerned, again, we're at new lows now for the last from the last 2 years. But by historical standards, no, we're not at new lows. The lowest that we were at was back in 2019. So still plenty of scope there as well. So I do think it's a fascinating backdrop across, and I've just picked a few markets there. The S&P, which is interesting. It's fairly neutral as far as their positioning, marginally negative, so marginally short, and yet the S&P's at new highs. So certainly some question marks on some of these. The Australian dollar, question marks there. The euro is in line with what the euro's been doing. Plenty of scope for them to increase their shorts, and likewise with the New Zealand dollar as well. So fascinating markets all round there as we're, and from a positioning perspective, as we're coming in to the new year. So look for historical extremes in the positioning of those large speculators, or divergences with price, a bit like in the S&P right now. Well, they're actually net negative, and yet price is practically at all-time highs, there or thereabouts. And yet we've got euphoria, as I've already said, from a sentiment perspective. And we've got breadth breaking down a bit, not confirming the moves. So certainly some question marks going into 2025. So I think going into next year, there's likely to be increased volatility because of a Trump presidency is going to change the world order to an extent as far as his policies and how other economies have to respond to any of his changes in policies. I think that could be really good for the dollar, as we've gone through several technical charts there with regards to the dollar itself, against other currencies. And of course, be cautious, I think, towards the stock market. Don't think, oh yeah, the stock market's going to go up another 20 or 30%. That's what everyone is thinking at the moment. And you have to be cautious when everyone's thinking the same thing. You have to look the other way. So note those big picture chart patterns. Sentiment is very optimistic out there, and regularly check that hedge fund positioning. Just so you know, on tradingstir.com, that is updated every Friday evening. Just so you know, it's only updated. Those stats are only updated once a week on a Friday. So they'll only change once a week. But it's good to get used to looking at them across some key markets like I've just gone through this evening, and you start to see these patterns at times. You're not going to trade off that information per se, but like I've just presented here this evening, it does sometimes give you some question marks against some certain markets, because you want to see those big fund managers, the big hedge funds and the likes, like we've seen with the likes of the euro, etc., moving in tandem with price. When they're not, it raises question marks. Oh, yeah. And finally, there's Giuseppe's email again. Let's all send him a load of emails, and so he can wake up tomorrow to a load of email inquiries. So that's the email there for Giuseppe at Tickmill. If you have any questions with regards to Tickmill itself, then just fire them to him. Now, I've gone through that presentation probably a little bit quicker than I would usually try to, but I'm very much aware It is FOMC. And so we've got a lot of news about to come out this evening over the next hour or so, what with Jerome Powell talking over there in America. And so I'm very conscious of that. But if anyone's got any questions, by all means, do fire away if you've got any questions here. So I'll just allow a little bit of time here for questions. What's the website for the fund managers? Yes, Ollie, I see your question's been answered there. So it's been put in into the into the chat box there, but I'll just quickly come out and go back to it. It's tradingstir.com/cot. Now I need to the presentation slide back up. Wow, there's loads of us in here. There's like 80 people in, and I'm not seeing any questions. Normally, I'm inundated, so I've got 10 minutes to answer questions. So if you've got any questions on anything, by all means, here they are. They're starting to come through now. Which link do you use in the TradingStir website to see what the hedge funds are doing? I think I've just covered that, Ash. So I'm pretty sure I just covered that. So yeah, tradingstir.com/cot. Why is Tesla performing out of the fundamentals? That often happens with individual stocks, but a lot of the performance that we get with Tesla is coming from ETFs, for example. ETFs have to hold some of those biggest stocks, so money piles into ETFs and it just keeps on therefore benefiting those stocks. But it's also about what big investors are looking to do. They're looking further out. They're looking out 2 years to 5 years down the line. So they're not interested in what necessarily the fundamentals are right now today. They're looking further out at what their potential future earnings are. And so yeah, that's what we tend to be seeing there. Right, loads of questions coming through now. See, right. What is the biggest advice you could give when it comes to trading CFDs, especially for someone who's newer to day trading? Well, for starters, Zoe, you don't have to day trade. You can swing trade. I see that question was to host some panelists, so not everyone's seeing these questions. You can change the drop-down box so everyone can see your comments, by the way. What's the biggest piece of advice? Well, just use a position sizing calculator and make sure you only risk a maximum of 1% of your trading account per trade. That's it. If you're day trading, I would say it should be more likely 0.5% or less, especially if you're planning on doing day trading. So that's the biggest piece of advice. But that would be the same if you were trading CFDs or if you were trading futures, whatever. Then I would give you the same advice. So it always comes back down to your risk and how much you're risking per trade. So yeah. So CFDs are fine. I trade CFDs. Tickmill are a great CFD and futures provider, and their costs are very low. So it's not so much CFDs themselves. It'd be the same if you're trading futures, options, you name it. But only risk a very small percentage of your account per trade. Which is the best trading moving averages to adopt in trading? Well, I don't know if it's with regard, I do use moving averages, but I don't know whether it's which ones are best. It's which ones are best for you. So I'm just going to highlight some of the moving averages that I use. You have to decide yourself which ones you really want. So I use a 10, I think it is a 10, a 20. Some people use a 21, and some people use an 8. So 8, 21 because they're Fibonacci numbers. But I use a 10, 20, a 50, and a 200. And actually, I use a 100 in there as well. So I have several moving averages on. But you don't need to use all of those, but that's what I use, and I like using them. I have a specific way of using moving averages. That would be in itself a webinar. Maybe that's just given me an idea for maybe a webinar in the new year. But yeah, that's what I use. I knocked you out, Johan. Yeah. Usually with the dollar index being strong, stock market weakens. That's true. And this is what I've sort of alluded to there. Who's put that down? So coming back to, let's go to the dollar index. Oops, where am I going? There we are. Correlations. So what you're talking about there are correlations. Correlations actually break down quite a lot. So it's a general rule of thumb, but it's not something that happens all of the time. So normally, when the dollar's going up is what was said there, stock markets are going down. And that's not, the dollar's been going up, but so has the stock markets. So there is different context that goes on in different years for varying reasons. The bond market is a big factor at play as well. So if the stock market fell next year, then yes, that we could well see a stronger dollar. But as we've already seen, a stronger dollar over recent months, and the dollar and the stock market's been going up as well. So, yeah, correlations do break down for long periods actually. So they're a correlation. Nothing's guaranteed, but we'll see how this all plays itself out as we go into 2025. Florin, hi Florin. Any bias about crypto, especially Bitcoin? Yeah, good question. Let's come out to. So I can. Why is it not letting me escape? That's weird. Oh, there we go. So if I come over to Bitcoin, the question: any bias about crypto? If I put this onto a weekly chart here, especially Bitcoin, the only thing I can say to you is Bitcoin is comment on the trend overall. Bitcoin is in a very strong trend, and as we know, at some point it will do a pullback, but the trend is up. That's all I really can say. So my overall bias is to the upside purely because that's the trend. And so, of course, it could do a pullback, but I would see pullbacks should be seen as buying opportunities until proven otherwise. That's how most traders would look at that. So, do your long short positions coverage depend on your open positions, or do you use chart values, technical analysis independently of your exposure? I don't know what that means, Carlos. I'm sorry, I don't understand your question. Long positions coverage depend on your open positions. Yeah, I don't understand your question, really. Sorry. You'll have to rephrase it. Ollie, dear Charlie, any thoughts on the yen? Dollar yen is doing all right at the moment. Essentially, if the dollar is going to continue to, when we get into 2025, if we are to see a stronger dollar, then we would see a stronger dollar against the yen as well. Bank of Japan's coming up tomorrow morning, so we'll see what they say in that as well. Could you please explain and elaborate on the fundamental analysis on today's already published economic news on the euro, pound, and US today? How can one interpret those? As far as the fundamental analysis was concerned today, there wasn't any. There was so little. The major economic releases were really out of the UK this morning, and that was inflation. So there wasn't really anything meaningful out of the US. It was very low level out of the US and Europe. So the only higher level report today was out of the UK, and that was inflation. Right. I'm trying to rush through these because I have literally only got 2 more minutes. And so, Oliver, this was really interesting. Do you run regular streams? Yes, I do these every month for Tickmill. So if you're on Tickmill's email list, then you should get notified next month. And do, again, come back to the hub here where the previous recordings are all here. They upload them all onto this site here, and that was what was the if I can find the actual link. It's tickmill.link/Charlie Burton. So if I bring up the slide again, there you go. tickmill.link/Charlie Burton, and you can get the historic sessions. But I'll be back in January for the next session, of course, as well. So I'm really sorry tonight, but because of the Federal Reserve, I have got to dash in just a minute or two. So let's have a look. Monsieur Du, looking at the BRICS creating a new currency. Yeah, that's not going to happen. Sorry, not in the near term. Don't expect it. It won't happen. There'll be a lot of talk, but it won't happen. Evening, could we get a chart view of the general direction of gold? Let's go back to gold here. The general direction for gold. Although gold at the moment on the daily charts is in a bit of a pullback at the moment, the overall trend is still very much to the upside, the bigger picture view. But so my overall view of gold, like many, this is in an upwards trend. If I take this out to a weekly time frame, but yeah, it could be maybe due a bit of a pullback. But even if it does a bit of a pullback, I'd then be looking for opportunities, but to see it reverse back in the direction of the trend again. So overall, don't get me wrong, gold could do a bit of a pullback relative to this run that it's had. It could certainly do a bit of a pullback heading back down to, 2,500 or 2,400. Absolutely, it could do. But it's still in the context of an upwards trend. So everything has to breathe in and out, as I always say. So, overall, it's in a bull market. There's not much more I can say about that. I really am now out of time, folks. So I'm really sorry I'm not answering if I've missed any. I know that someone's asked about the Dow, but it's the same. Go back over tonight's recording. It will be uploaded onto that hub within the next week. And so do that. And I would love to see you again in January. If you sign up with Tickmill, you'll certainly get notified for January anyway, and do check them out because they are, like I've said, they've got some really good, their charges are low, their overnight fees are one of the lowest that I've seen of some of the big brokers, really competitive, and a very nice company to deal with. So anyway, hopefully I'll see some of you then. I'll probably do a webinar next month on moving averages. It's given me an idea. Take care for now.